Hello everyone. Let us tackle the theory of supply. The law of supply is a fundamental principle of economic theory which states that keeping other factors constant, an increase in price results in an increase in quantity supplied. In other words, there is a direct relationship between price and quantity. Quantities respond in the same direction as price changes. This means that producers are willing to offer more of a product for sale on the market at higher prices by increasing production as a way of increasing profits. In short, the law of supply is a positive relationship between quantity supplied and the price and is the reason for the upward slope of the supply curve. To know law of supply, we should know what is supply previously. Supply is the quantity of a good or service that producers are willing and able to provide at a given price, at a given time. Law of supply is the microeconomic law explaining the characteristic of the supply, stating that all other factors being equal, as the price of a good or service increases, the quantity of goods or services that suppliers offer will increase and vice versa. The law of supply says that as the price of an item goes up, suppliers will attempt to maximize their profit by increasing the number of items for sale. This is because the price goes higher, producers will be more willing to provide more of their goods or services. Every business exists to make profit, and price increasing gives signal to producer to increase their price to make more profit. Therefore, higher price is inducing producers to make more. What is supply function? The supply function in economics is of utmost importance to businesses. They can establish the optimum quantity-price relationship to control costs and make high profits. Firms can study the variations in quantity supplied with price changes. Supply function explained. The supply function formula is as follows. QA is equal to F close and open parenthesis PA, PBXYZ. Here QA is the quantity of a commodity A supplied. PA is the price of commodity A. PB is the price of related commodity B. X, Y, and Z are other variables affecting the product supply, like the cost of production, government intervention, level of technology, etc. Let us look at the various factors affecting supply function in detail. Firstly, the price of related goods like complementary items and substitutes affects the price of a particular commodity. Consider, for example, a printer that costs $200. If an ink cartridge costs $150, people will not buy the cartridge. Similarly, it is important to take into consideration the competitors' prices. Therefore, a too high or too low price can be both dangerous for a business. Secondly, the cost of production affects the selling price. This is because the final price is nothing but profit added to the production cost. Therefore, a higher cost will correspond to a higher price. A high cost can directly affect the capacity of a firm to supply. Production cost includes raw materials, wages, and other direct and indirect expenses. Thirdly, government interventions and policies control the supply level. For example, the government can restrict the amount of a certain commodity that one can supply every month. Lastly, the level of technology affects the speed of supply. Like advanced production techniques and technology can enable sellers to supply more. An ideal aggregate supply function can be plotted as a slightly convex line passing through the origin. This shows that as price increases, supply also increases and vice versa. That is, if the price of a commodity is high, the seller will be motivated to supply more as they can earn more selling high. What is the law of supply? The law of supply or supply function is based on a changing amount of materials available to satisfy a specific demand. It states that A higher price will cause producers to supply a higher quantity to the market. Supply is an output of economic activity. It can apply to measure demand. Oversupply results in loss of producers. For example, if 10 people want to buy a phone and there is only one phone, then the trade will be based on the level of demand for the phone. The supply function requires more phones, which produces more production to match demand. The law of supply is the microeconomic law that states that all other factors being equal, as the price of a good or service increase, the quantity of goods or services that suppliers offer will increase. Understanding the law of supply. The chart below depicts the law of supply using a supply curve, which is upward sloping. A, B, and C are points on the supply curve. Each point on the curve reflects a direct correlation between quantity supplied, or Q, and price, P. So at point A, the quantity supplied will be Q1 and the price will be P1, and so on. The supply curve is upward sloping because over time, suppliers can choose how much of their goods to produce and later bring to market. At any given point in time, however, the supply that sellers bring to market is fixed, and sellers simply face a decision to either sell or withhold their stock from a sale. Consumer demand sets the price, and sellers can only charge what the market will bear. If consumer demand rises over time, the price will rise, and suppliers can choose to devote new resources to production, which increases the quantity supplied. Demand ultimately sets the price in a competitive market. Supplier responds to the price they can expect to receive sets the quantity supplied. The types of low supply. There are 5 types of low supply: market supply, short-term supply, long-term supply, joint supply, and composite supply. Meanwhile, there are 2 types of supply curves: individual supply curves and market supply curves. Individual supply curves graph the individual supply schedule, while market supply curves represent the market supply schedule. What is producer surplus? Producer surplus is the difference between the price a company is willing to sell and the actual price a consumer pays. The supply and demand curve intersect at a point known as economic equilibrium. At equilibrium, both consumer surplus and manufacturer surplus are equal. When the market price increases, it works in favor of the producer. In contrast, when demand plummets, the price also declines in favor of the consumer. This is known as the consumer surplus. To calculate producer supply, marginal cost is subtracted from the company's total revenue. Every manufacturer or service provider tries to maximize the manufacturer surplus by maximizing sales and higher prices, but beyond a point, inflated prices reduce market demand. Producer surplus in economics explained. In a business transaction, producers often make a hefty profit, but this is at the cost of the consumer, who ends up paying extra. If producers benefit more, the transaction is called producer surplus. Obviously, all manufacturers want a surplus in their favor, but in free markets, this is balanced by a consumer surplus. Consumers enjoy lucrative bargains when supply is high and demand is low. Producer surplus directly measures a company's profit based on the difference between production cost and market price. It is not always necessary for every company to earn a surplus if the market is at equilibrium. It is a healthy condition for both the consumer and the producer. The producer surplus definition is crucial for studying producers' contribution to the economy. There can be multiple companies operating in the same industry. Competition regulates the market price of a particular commodity in competitive markets. However, in a monopoly, producer surplus is the maximum. In a monopoly, a single company becomes the price leader, or a few market leaders set the price. Consumers have no substitutes. Again, whenever producers enjoy huge profit margins, it is at the cost of the consumers. The producer surplus definition highlights how producers are willing to accept a lower price, but the market conditions favor them, resulting in high profits. Low product supply and high commodity demand are common causes of manufacturer surplus. This means a new entrant can break a monopoly by selling below market price and still make a profit. Formula. Now let us look at the producer surplus formula. Producer surplus is equal to market price minus producer's minimum acceptable price. Alternatively, it is also calculated as follows. Producer surplus is equal to total revenue minus production cost. The surplus equation is as follows. Producer surplus is equal to 1/2 times Q1 times P1 minus P2. Here, Q1 is quantity, P1 equals to price, and P2 producer's minimum acceptable price. Equilibrium of the industry, short run and long run equilibrium. Since the price of a product under perfect competition is determined by the intersection of the demand and supply curves of the product of an industry, we need to know the nature and shape of the supply curve of a product under perfect competition. We shall now explain how the supply curve of a product under condition of perfect competition is derived and the shape it takes both in the short run and the long run. Before explaining the derivation of the supply curve, we shall discuss the concept of the equilibrium of the industry under perfect competition. It should be noted that the concept of industry is only relevant in case of perfect competition, since only under perfect competition a large number of firms produce identical or homogeneous product. An industry is an equilibrium when there is no tendency on the part of the industry to vary its output, that is, neither to expand output and nor to contract it. Now, the essential condition for the absence of any tendency for expansion or contraction of industry output is that the demand for the product of the industry and the supply of it by the industry are in balance, that is, in equilibrium. Unless the quantity demanded of the industry's product and the quantity supplied of it are equal, there will always be a tendency for the industry output to vary. If at the given price the quantity demanded to the product exceeds the quantity supplied of it by the industry, price of the product will tend to rise and also the output of the industry will tend to be increased. On the other hand, if at a price the quantity demanded of the product falls short of the quantity supplied of it, the price and the output of the industry will tend to fall. Thus, only when the quantity demanded and the quantity supplied of the product of the industry demanded and the quantity supplied of the product of the industry are equal, there will be no tendency for the industry either to expand its output or to contract it. We therefore conclude that industry is in equilibrium at the level of output at which the quantity demanded and quantity supplied of its product are equal, or in other words, at which the demand curve for the product of the industry and the supply curve of it by industry intersect each other. Short-run equilibrium of the industry. We must distinguish between the short-run and the long-run equilibrium of the industry. In the short run, only existing firms can make adjustment in their output while the number of firms remains the same. That is, no new firms can enter the industry, nor any existing firms can leave it. Since in the short run, by definition, the entry of exit of the firms is not permitted. For the short run equilibrium of the industry, the condition of making only normal profits by the existing firms, or in other words, equality of average cost with average revenue, is not required. Thus, the industry is in short-run equilibrium when the short-run demand for and supply of the industry's products are equal and all the firms in it are in equilibrium. In the short-run equilibrium of the industry, though all firms must be in equilibrium, they all may be making supernormal profits or all may be having losses depending on the demand conditions of the industry product. We therefore reach the following two conditions for the short-run equilibrium of the industry under perfect competition. Number one, the short-run demand for and supply of the product of the industry must be equal. All the firms in the industry should be in equilibrium whether they are making economic profits or having losses. Long run equilibrium of the industry. In the long run, number of firms can vary, lured by economic or supernormal profits earned by the existing firms. In the short run, the new firms will enter the industry and compete away these economic profits, and thereby all the firms will be in long-run equilibrium at the minimum points of their long-run average cost curves and will therefore be making only normal profits, that is, zero economic profits. In the short run, if the existing firms make losses, some of the firms will leave the industry so that the output of the industry will fall, and as a result, the price will go up to the level of average cost. Thus, as a consequence of the exit of some firms, the remaining firms come to be in long run equilibrium where they are earning only normal profits. The industry is in long run equilibrium when, in addition to the equality of long run supply of and demands for industry's product, all firms are in equilibrium, and also there is neither a tendency for the new firms to enter the industry nor for the existing firms to leave it. We therefore arrive at the following three conditions for the long run equilibrium of the industry. The quantity supplied and demanded of the product of the industry should be equal. All firms in the industry should be in equilibrium. There should be no tendency for the new firms to enter the industry or for existing firms to leave it. In other words, number of firms should be in equilibrium. This implies that all firms in the industry will be earning only normal profits in the long run. In economic competition theory, the zero profit condition is the condition that occurs when the industry or type of business has an extremely low cost of entry to or exit from the industry. In this situation, some firms not already in the industry tend to join the industry if they calculate that they will make a positive economic profit or profit in excess of the cost of acquiring investable funds. More and more firms will enter until the economic profit per firm has been driven down to zero by competition. Conversely, if firms are making negative economic profit, enough firms will exit the industry until economic profit per firm has risen to zero. This description represents a situation of almost perfect competition. The situation with zero economic profit is referred to as the industry's long run. According to the theory of contestable markets, if few enough firms are in the industry so that one would expect positive economic profits, the prospect of other firms entering the market may cause firms in the industry to set prices as if those other firms are already in the market. Thus, actually, entry by those firms is not necessary for the market to appear perfectly competitive. Economic rent rates and price. Economic rent refers to the amount paid to the owner of a factor of production over the cost that is to be necessarily incurred on utilizing such elements in the production process. These factors of production could include land, labor, capital, etc. It represents the amount earned by the owner over and above his expectation or what he would have made in the normal market scenario. If we procure anything from a producer, we need to consider him. In an economic sense, when the amount paid for the procurement is more than what the producer was reasonably expected to receive, it amounts to economic rent. They can arise when a certain set of producers in the market have access to some important financial information that others are not having, or they are technologically more advanced than the other producers in the market, making them low-cost producers. They are thus able to fetch better prices for their produce. The formula suggests that one can derive the value of economic rent by deducting the free market price from the agreed price of the factor of production. The agreed price, the price that is decided upon between the buyer and the producer. Further, the free market price is the producer's amount in the normal market. Thank you. This is only for educational purposes of the Northern Western Agusan Colleges by Miss Diane Itima, our instructor of microeconomics. This is Jola Javar Codera of BSBA 2/3 schedule.